Alright, hope everyone's doing great today and had a great day. So, just with a few things, this is kind of what, well, he mentioned moves. Arguably a spike down, 15-minute chart. This actually kind of makes sense. You had, well, 4 bear bars and possible climax. So, I'll just leave those there for a minute so people can see them. Point being, today was a very, very interesting day. As you can see, so I'm going to get rid of them right now. So, biggest thing was the 50% pullback. And if you were in the room, you heard Al talk a lot about that. $60-minute chart. We've had big down, big up, big down. And we are around 50% of this prior leg. So, arguably this is pullback from that. This was a pullback. So, breakout pullback, buy, inside bars. For the bears, bears want 2 legs down. And nobody knows. Look at the chart. We went down and we went up strongly. So there's probably going to be a fight over what side wins. And it's really as simple as that. So coming into today, 5-minute chart, possible wedge top. We expect 2 legs sideways to down. Consecutive buy climaxes. Bar 1, bar 1 and bar 2, pick a direction. Terms of always in. Bar 3, still tight trading range. Possible trading range day. Bar 4, probably probably always in short. Maybe sellers below bar 5, definitely always in short. And in terms of always in, arguably here, we had the attempt at a wedge and we didn't get it. And then we had a parabolic wedge, first push, second push, third push, never triggered. And then we had a second entry buy, kind of a variant. So you had a wedge bottom, first push, second push, third. And even though this did not trigger, it's still a variant, meaning find a small enough time frame, maybe a 3-minute chart, and as you can see, it triggered right here. It triggered right there. So kind of hard to see. First push, second, third, triggered, So with that said, some bear always in swing bears will exit here and give the market some time. And now we have a low 2 short. We are close to the 50% pullback, so probably not a lot more down. However, I think always in bears have to get back in, and they will short below this. Here, strong enough breakout, bears will exit. We're probably always in long based on the bar. Well, actually, it's really aggressive to say. So, anyone buying through here has to realize it's a trend line break. So we've had an obvious bear trend. Trend line break, we'll probably have to test down and get some sort of higher, lower, lower, low major trend reversal. And that was the whole thing today. The whole decision today was, are we going to get bear trend, trend line break, a higher, low major trend reversal, which we got, or were we going to get leg 1? So something like leg 1, maybe here, pull back to leg 2, which obviously we did not get. So, 2 good bars for the bulls, probably always in long. However, I think bulls should get out somewhere below here. The first reversal is usually good enough for a scalp, because swing traders know there's a 50-50 chance we fall below here. So obviously, why risk from here to here when there's a 50-50 chance you get stopped out? It's not good math. So a lot, aggressive bears will short, arguing it's still always in short after all this. Bulls either get out here, maybe here, definitely somewhere in here. And if bears go short, they have to be realizing that this could quickly reverse as it did here, with bulls betting on a major trend reversal. This bull bar probably enough to put it always in long. However, the two greatest problems for the bar is one, where is the follow? There's no follow through yet. So if you buy this close, A, lower high, possible lower high, possible second leg trap, leg one, pullback leg two. Could not test these closes, and then where's the follow through? So that's why do you think this bar had? Why do you think this happened? Well, think about the math for a minute. If I'm a bear, why not sell this close, put a stop up here, betting on it, going for twice my risk, or simply, let's just look here real quick. So here's 2 times. Now look at that. So why is it that if I'm a bear, it's very coincidental that if I sell this close and put a stop 1 tick above this, betting on a new low of the day, why is that twice my risk? Well, think of the probability. It's probably 50-50. I wouldn't say it's not. You have to look at this and this. Look at the rally, big bull bars, not great bear bars. Look at the sell-off, not great bear bars. Where's the consecutive bear bars? Big bull bar. Even through here, you have to think this is kind of parabolic. It's at a 50% pullback on the 60-minute moving average. It's not a great bear trend. So, if we think about the math, you have to be aware that there's an actual 40% chance, give or take, maybe even better than that, because you could argue it's still always in short until the bulls get above here or get a decent follow through. So, bears will short in the upper half of this range, and also, look at this. I hadn't really thought about this until now, but it all coincides. Let's look at, I bet this is up the upper range. 1 second, I'll tell you what I'm talking about. Yeah, look at this. So here is the prior bear leg down, and these blue lines represent the upper third and the bottom third of this leg. Now, and if you believe it's a trading range, a lot of traders will sell in the upper third of the prior leg and buy in the bottom third of the prior leg, which makes sense. Well, look at this tail. Arguably, we either went 1 tick above the upper range or could not get above it and then immediately sold off. So, those kind of things, you don't have to know them. You don't have to be aware of them. But the more you understand, the better, obviously, your edge is, So, overall, the main concept is until we break above a lower high, it's not strong always and long. So you have to remember, if you buy this bar and put a stop down here, you've got a large risk. So it becomes really tricky. Second, another thing I would point out is, let's say you do buy this close. If you buy this close, your stop's down here, at least, probably a minimum. That's where I'd put it. Well, here, you either get out very quickly up here, maybe this bar was not this long, it was probably this size around for 4 minutes, into the bar. And the last minute, 30 seconds, it just plummeted down. Why is that? Well, the market's trying to trap traders. If I'm a bear, especially a computer, or if I program computers, if you will, I would make a bar. I would aggressively buy this breakout. Buy, trying to drive the price as high as possible. And right at the very end, I would short, for a scalp. So, point being, if you did buy, I would not get out down here. Maybe you get out on the stop below this bar, but really you have to think about that. If I buy and sell out of my long below this bar, I'm selling at the bottom of a trading range, which is not a good thing. So I tend to think you're better off just trust the stop. So, you just say, okay, I screwed up, bought, price down here. I'm for my stop down here, and maybe I'll go for something like this. And look what happened. Now you can see a lot of traders did just that, or even here. That's, arguably that's one of the reasons why we sold off over here. So it's kind of the middle of the road. I've been looking at that a lot, and that is, for example, you buy here and you don't get out here at the right, the early place to get out, and then you get out down here. So the worst thing you can do is get long up here and get out somewhere down here, buy up here, get out down here, be long, get out here. There's really no difference between being long and exiting a long here and going short here. It's still selling. There is obviously a difference, but it's still selling at the bottom of support, and that's a losing strategy no matter what context you bring it in, no matter how you look at it. Same thing with here. If you buy up here, maybe you put your stop down here and then you look to re-enter. That don't sell out. It's kind of tricky. I wouldn't sell it down here. So just something to think about. Other than that, bulls really need follow through. They can buy, put a stop down here, and just hold all day. And finally, they'll win. So, yeah, I think bulls would get out here, maybe very short, and then you got this big bull bar. I guess bulls buy again there. Maybe they sell out of a long below this bar, above this bar, maybe even below here. But once again, it's really not that simple. There's not an easy answer. Second, this was a clue. It's a big clue. If you think about it, when the market begins to go sideways, it's usually going to continue to do what it's been doing. So you have to wonder. 60-minute chart, big down, big up, big down. Doesn't that look really familiar? That looks a lot like this day. We went up, down, sideways, and eventually we picked a direction at the end. Well, that's because, when you have something that's confusing, confusion is the hallmark of a trading range, which means sideways. So, let's get back to where we were. Anyways, so when you see this big bull bar and then no fall through and this big bear bar down, you have to think, big risk forcing me to buy high, big risk forcing me to sell low, limit order market's probably going to go sideways, and you get a big bull bar. Then we go back down. Big bull bar. What do you think is going to happen? What do you think is really going to happen? After these three bars, traders are probably going to exit. So, real quick, why would traders get out here and not get out here? Think about it. Big bull bars, three bear bars down, three bear bars down. Well, so what's the difference? Well, context. You have to remember, when there's a clear trend, traders will sell for any reason. Or, excuse me, in this case on the left, they will buy for any reason. And they know that, I could buy this high tick and put a stop down here, and I could go for a target here. Look what happened. Here's 1 times your actual risk. We sold off. Well, let's say 2 times the risk. I wonder if we can reach that. Well, I guess that doesn't really matter. Traders will go for a measured move of this and come back in like 6 hours, whatever. Obviously, it's not 6 hours. So, point being, it's a bull trend. The bears need to do a lot to really convince traders to sell out of their position. Here, 60% chance we're going higher, but the bears really will have to, they're going to have to get at least 10 bars sideways or some big bear bars to really convince traders to get out? Well, look at today. We're bear trend. Where's the consecutive big bear bars? Well, arguably here, but here's 3 consecutive bars. Tail, bigger body, smaller tail. Usually that's not how trend work. Trends usually, they do this. You get, big bar, another big body, consecutive bodies. This has a look of a trading range, and it's also following this whole move. So back to what I'm talking about. Here we have attempted a trend line break, so there's probably going to be a test down. Bulls will be very quick they won't need much to exit longs, especially at the moving average. It's the first time bears can short at the moving average. It's a reasonable thing to do. Well, bulls are looking for the major trend reversal, the higher low major trend reversal, the double bottom, the lower low major trend reversal. They don't get it. They don't get a good signal bar, and that's a big hint. Bad signal bar, forcing you to buy high, big up, big down, more up, more down, more up, drifting down. So whenever there's clear signs of trading range price action, what's the number one most logical thing to happen in a trading range? Well, failures. Look what happened here. Bears were so eager to either do one of 2 things. They were eager to sell and maintain lower highs and lower lows. This, I don't consider that a lower high because we did not make a new low. So bears were eager to short. And because of that, we have not broken above a lower high clearly, even though we have 3 decent, 3 bull bars, however, waning momentum, big bull body, and what I mean is momentum's drying up, big bull body, smaller. When we get 3 consecutive bear bars, that is plenty that's enough to make traders look to get out. They don't need something that strong. Whenever there's hesitation at the top of the trading range, people are not going to stick around because they know the odds favor the odds favor a failed breakout. 80% of breakouts fail in a trading range, so we'll probably test down. So just kind of be aware. Remember that bears once. It's similar to. It's kind of a different point, but we're selling off. Bears tried to get a trend line break and couldn't get it. We're selling off. Bulls tried to get a trend line break, broke above moving average. However, when it starts to hesitate, bears give up because the odds favored a sell-off or trading range at best. Here, this is a pretty good example. Big down, big up. Well, testing up. We're trying to get above a trading range, trying to get above, arguably a bull trend line break, lower high. We tested down, not strongly, so bulls are going to buy. Well, you can say bear trend line break, higher low. Well, it's a higher low major trend reversal. Bulls are going to buy and betting on, more up. Well, bad follow through, bear body, another bear. Bulls are going to give up because they know the odds favor a failed breakout. Here, look right here. Excuse me. Voice getting a little dry. Double top. Well, every double top, it's a type of major trend reversal. Bears want to measure move down. Well, we failed to break out to the upside. We're probably going to turn down. Look what happened here. We could not even get below. But once we start to go sideways for long enough, bulls are going to be quick to get out. Bulls giving up, more bulls giving up, and then we eventually broke the upside. So, point being, when you're in a trading range, people are much more quick to get out. And so, here, very confusing. But the one thing I would either get out, get out above, get out below. The worst thing you can do is get out, buy, get out, buy, get out. So either, if you're really having trouble deciding where to get out, and because it's hard, the market's always going to, the whole point is to facilitate trading, to get you to buy or sell, at more than you should. If the market just simply broke to the upside, turned down, and then, had 3 clear bear bodies saying, gee, it's going down, well, that'd make you get out quickly. This kind of makes you wonder. So I guess what I'm saying is, you get out up here, or you just put your stop down here. Let's say you bought this high close, go for a walk, put it down here, go for a walk. If you get stopped out down here, that's fine. Re-enter and look to hold. So you have to remember that the market's always gunning for this. In other words, logical stops. Here's a logical stop. We broke below it. Logical stop, broke below it. It turned up. So not really a whole lot to say. The whole day, the decision on the day was trend resumption, trend reversal. This day we got trend reversal. Let's give me 1 second. Can I? Whoops. Maybe. Yeah, you can kind of make that argument. Bull trend, sideways, more up. Oh, I like that example. That's the same day. But anyway, bear trend, sideways, broke the downside. I think here the market favored, reversal. Not really a strong bear trend. And this, big down, big up, big down. Well, sideways, we're hesitating at a 50% pullback. So, it's kind of reasonable for that to happen. So, alright, let me know if you have any questions. Hope everyone has a great evening. Oh, real quick, actually, last thing I'll say is, anyone questioning asking about initial actual risk, that is simply, you have to remember, the whole purpose of that is a measurement. It's not, everything's subjective. My biggest advice is to maximize, if you're ever struggling, if you're having trouble recently with not making, if you're unprofitable at this moment, maybe you were recently, you were profitable, now you're not, you're trying to figure it all out. When in doubt, go for swings and increase your targets. However, with that said, be smart about it. Don't sell here and go for 30 points. You're probably going to lose every time. What I mean is, if you, even if you bought this close, say, okay, I'm just going to buy this. I'll put a stop down here, buy this, and I'm going to go for a walk, and I'm just going to wait. Well, you might win, you might lose. The whole point is with swing trading, you don't lose 40%. You really, a good swing trader, some 40% of the time you get the huge moves. You get those twice your risk and all those big things. 60% of the time you lose a little, you make a little, and then sometimes you get stopped out. Physically. You buy above, and you buy above here, get stopped out. Point being, actual risk is simply a measurement. If I was to sell this high, I could, for example, set it up for you. Okay, if I sold here, wide stop, when price turned down, I could say, okay, my actual risk was 1 tick above here. I'll go for twice my risk. Well, that takes me back to this 50% area somewhere down here. Right? It's just a measurement. I would not go for twice my actual risk on every trade, because sometimes if you're risking 4 ticks, that's only 8 points. You don't going for the minimum target is not always a good thing. It's fun to get in and out. It's fun to buy here and go for 2 points or whatever, but that's not always best. So scalping's hard. It's I mean, there's nothing wrong with it, but when in doubt, try and maximize your targets. If you sell this close and you're saying, gee, I don't know what to do with the target, well, you could easily pop up a 15-minute chart and say, okay, let's just say, actually, I'm making this more difficult here. You look here, you say, we're going down, okay, so I'm going to, maybe you sell, let's say you sell the worst close, you sell this close. Well, somewhere in here. Anyway, here. Sorry, I got kind of distracted for a minute. Anyways, let's say you sell here. Well, you could simply say, okay, I'll put my stop up here. I'll sell down here, and I'm gonna wait. You can clearly get twice your, 1 times your initial, and in that case, it's great. 2 times. So remember his price. We'll say 67. You went for a target at 67. Well, that's 1 times your initial. If you went for twice your actual, you have to remember that's twice your initial, and that's not really, that's not always best. You would be given, in both those scenarios, you leave a lot left on the table, and sometimes, just remember it's the minimum approach. So when in doubt, go for more. And all right, hope everyone has a great evening.